Hello, and welcome to Electrifying Growth, a podcast brought to you by Edison Partners. I'm Chris Sugden, managing partner here at Edison and your host. There are moments in a person or company's journey that are undeniably electric. The spark or sparks, if you will, that propel you or your company to new heights. With Electrifying Growth, we're here to have in-depth, real conversations with great leaders who have been there and done it before. Edison has been investing in high-growth technology companies for more than 35 years, and I have been here at Edison doing this investing piece for more than 20 years. We've led over 225 investments. We understand that it takes great leaders and visionaries to build market leaders. We are your support system, a CEO and management's entourage, if you will. Let's introduce this episode's guest. Welcome to another edition of Electrifying Growth. I'm your host, Chris Sugden. Today, I'm really happy to welcome a guest for what I call this episode, the other side of the table. Michelle McKinnon, who is a senior portfolio manager of alternative investments with Loews Corporation, is a limited partner, and we'll talk more about her role and what limited partners do on this episode. But we don't often get that on Electrifying Growth. We talk to operators and entrepreneurs and directors, but hearing a little bit more from those who, as we'll actually also talk about, allocate capital, I think it's a really unique point of view. For those who don't know Loews Corporation, a New York Stock Exchange listed company, a holding company that's engaged in commercial and property casualty insurance through CNA Financial. They actually own a transportation and storage of natural gas business called Boardwalk Pipeline. They also own packaging, Altium Packaging, and then, of course, the eponymous Loews Hotels, which I'm sure many of you have stayed in. All those businesses owned by the Loews Corporation. I've actually known Michelle for over 15 years, and I've always found her opinions on investing to be balanced and constructive. She has significant experience in both as a fund investor and a direct investor, as we'll also talk about. And importantly, she started her career early days as an operator, which we'll also talk about. She began her career at Loews Corporation, where she was also a manager of alternative investments for the company's pension plan. And prior to that, she was with SiriusXM Radio. For our younger listeners, you wouldn't know that those two brands were separate. And in the days of content creation, they were one of the early ones in spending tons of money to create content and sign talent up. And in that role, she was VP of Finance and FP&A and also in investor relations. And then before that, she was in investment banking. So Michelle's got a great set of diverse skills, but the last 15 plus of allocating capitals we'll talk about, you'll really find insightful. So really happy to have Michelle McKinnon from the Loews Corporation join me today. Michelle McKinnon, welcome to Electrifying Growth. Thanks for joining me today.
Oh, it's a pleasure, Chris. Thanks for inviting me.
Absolutely. As I noted in the introduction, I called this one A View from the Other Side of the Table, and the other side being the investor side, the limited partner LP side. And people throw out things like LPs and GPs and institutional investors, but I think our audience tends to be more operator. So we'll come to your background in a second, but give us a little tutorial on what an LP or institutional investor is. And, you obviously with your time at both Honeywell and Loews, you've got the view. So share a little bit of what you all do for a living on that side of the table.
Sure. Well, to take the sort of technical limited partner term out, the type of investor is probably a better way to describe what a limited partner is. So I think there are about 5 sort of main categories, maybe 6, of limited partners. So public pensions. So there's in the US, at least the state pensions, that the teachers, the employees,
firefighters.
Exactly, firefighters, et cetera. So there's the public pensions. Then you have insurance companies, and that's what I represent, an insurance company. So insurance companies have 2 main lines of business. One is providing insurance to their customers and writing policies. And then the other side is investing the premiums that the customers of the insurance company pays to make sure that there's enough return generated to pay out the claims and also to make some profit on top of that. So insurance companies would be the second. So now we have public pensions and insurance companies. The third, and this is in no particular order, sovereign wealth funds. So some of the biggest investors or the biggest LPs in private equity are sovereign wealth funds. So the Middle East and the countries that generate money from oil or other commodities, very large. Next, I would say that the corporate pensions. So there aren't as many of them as there used to be because a lot of companies now have 401ks, and the old defined benefit corporate pension is, a thing of the past, or at least in many companies, a thing of the past, but there are still, a number of corporations that offer an old defined benefit pension. Then endowments. So typically colleges and universities that have an endowment are often a limited partner in private equity. And then the last group, and I'm probably missing, I can add a couple of others that I think of, but the last group would be nonprofits. So, museums, large nonprofits that are well-known foundations. So all of those groups. And then you have outside the US, similar. So in Australia and in Canada, you have these very large, in Australia, they're superannuation funds. In Canada, they're Canadian pensions, again, often similar to the state pension that you would have in the US. So if you look at a private equity fund, the investors that make the commitments to the private equity fund or to the growth equity fund, and more in Edison's case, those are the limited partners. And a typical group of limited partners that make up a fund is some combination of those different groups. Hopefully that helps.
And it's really helpful. And at the risk of maybe going too deep, but I think our listeners don't always get this side of it. Like I said, every one of these flavors of LP, as you said, have a different approach to their model, but you all kind of have an allocation model, if you will. And maybe just talk a little bit about that. How do you think about what alternatives mean?
Yeah, that's true. I mean, different organizations and different types of LPs have very different allocations to private equity. And, historically, some of the US endowments have been known as, they were sort of the first to really invest heavily in private equity. Yale University is one that sort of always comes to mind. We'll talk about starting and having a much higher allocation of their endowment to private assets or to, private equity and other sort of alternative assets. And then for an insurance company, which is what we are, an insurance company has typically a much higher percent of fixed income allocation because the investments have to, like I said, earn enough return to cover the claims, but it's very regulated. And so you want to make sure that insurance companies are healthy and that their investment portfolio is healthy and able to cover all those claims in the future. So typically both property and casualty and life insurance companies tend to have, lower percent of their allocation to alternatives than maybe, a corporate pension, which maybe have a higher percent allocation to equities, public equity or private equity.
And in your experience, are hedge funds part of the alternative bucket, or they serve generally their own, almost more publicly traded, if you will? Do you know what I mean? Whose world does it fall under?
Yeah, no, my experience is, and I've done both here in my current role, my experience is that limited partners who cover hedge funds are not typically the same people. They may be at the same firm, but
right, different group.
The group of people that cover hedge funds are different typically than the group of people on the network of limited partners. And, as I do my job, you asked earlier, like, what do I do for my job? So we allocate. Another term that's used a lot these days is allocator.
Yes. Not the most flattering. I don't know.
No, it sounds like the allocator is another term that's being used for limited partners. So we basically have, let's just say it's a 5% allocation or a 6% or a 10%, or depending on where you are, allocation, and you allocate that amongst different managers. An important part is selecting the managers, and then an important part is sort of monitoring the portfolio. The way that private equity funds work is once we have made a commitment, it's more of a passive role going forward. But in order to sort of explain what the performance and how the performance is to the higher ups at whatever organization you're in, be it at the board of trustees or the senior management team or whoever it might be, you need to be able to describe how the portfolio is performing. Just, it's up 10%, but this company's doing that and this company's doing well and this one's being
what's the value driver? Why?
Yeah. So you have to understand the portfolio and then develop relationships with the key investors at each of the private equity funds so that you can develop that sort of line of transparency.
Yeah, so there's a lot more than picking a manager and letting it roll, which we're going to talk about in a second. We sort of skipped just the nature of the conversation. We skipped your background, which is interesting because, and I did that on purpose. I wanted folks to understand kind of the investment, your side of the table, as I said, as it relates to your career, investment banking early on, go to the operating side, which I think is pretty cool because SiriusXM and satellite radio was early days. It wasn't startup time, but it was pretty early. But then at the same time, getting close, I hate to date us, but plus 15 years heading towards 20 of doing this stuff, right? Talk about your career journey. And I don't think anyone don't totally plan us to be in your business or even mine for as long as we have. It's just going to happen sometimes. But talk about your career journey.
You and I both have, kids that are sort of starting their careers or heading towards that age when they're going to start their career. And the best piece of advice I give to anybody is that you just can't plan it. You have no idea because there's so many different points in your career where things can happen and a direction can change and you can meet somebody or something can happen and so it is entirely unplannable, I think.
100%. I agree.
At least to get where I am is definitely the case. So I did investment banking for a long time and I focused mostly on media telecom industry. And then I had my children when I was still doing investment banking. And that life is, it's a tough.
Not conducive.
People wonder why there aren't, so many women at the top of investment banks. Well, it's a hard lifestyle. So I made the decision to change and I went to work for SiriusXM. At that time, it was just Sirius Radio. And I was the head of investor relations.
I meant to ask you that. So you were on the Sirius side.
I was on the Sirius side, yeah. So I was working at Lehman Brothers in media when I decided to make a change and leave investment banking. And Sirius was one of Lehman Brothers' clients at the time.
I guess there's a story in there too, because you looked like you sort of had a crystal ball.
Yeah, no.
You left Lehman.
Well, I did, yes. I left Lehman in 2004, so 4 years before the unfortunate ending for Lehman. So I went to Sirius and I was the head of investor relations. And within 3 weeks, Sirius hired Howard Stern, which was the beginning of this sort of battle between Sirius and XM for content. Each of them were battling for content, but it became a very sort of high profile and extremely fun job. I mean, I really did enjoy it a lot. And, in my experience now being an investor, having had that experience, sort of understanding some of the dynamics of how does the CFO work with the sales or the marketing, doing the budget and the cultural aspects to a company and how critical that is and how different it is between different companies. I mean, I worked for SiriusXM and then I worked for Honeywell, this huge global industrial company, on the pension side, but you couldn't have two different cultures. And every company has a different culture. So Sirius was really fun. And during that time we had, I think it was 26, I may be one or two off, but we had 26 initiating coverage on Sirius while I was the head of IR because, with Howard Stern and the NFL, and there was a lot of focus on the industry at the time.
That's pretty cool. That's a lot. That's a big job as an IR person. I mean, 26.
Yeah, it was fun. And then I got moved out of IR and I moved into an FP&A function. And then because of my banking experience, I got to work on the XM Sirius merger, doing sort of the internal diligence and working with one of the major consulting firms who helped SiriusXM with the DOJ. So we got a second request from the DOJ, which is what happens when they're trying to fight, the antitrust police come in and try to fight. And we went through that process and we ultimately got approval. And
kind of interesting, right? Because that HSR, Hart-Scott-Rodino, and to your point, that group of folks in DC are getting a lot more attention these days because sort of this today, you wonder if it would have been approved.
Especially with private equity firms, it seems to be. But the question in that, will the government allow Sirius and XM to merge was based on the definition of the market. And that's always the key point is the definition of the market. Is the market just two satellite radio companies merging to become one, or is the market just the broad universe of listening and ways to listen to music and ways to listen to audio content, which, eventually that merger was approved. And at that time, there was some capital structure issues with the two companies. They had both, I think, fairly well known now. They both had spent quite a lot on their content. And there were some capital structure issues and they faced some challenges and the future was sort of unclear. And the company did a great job after the merger. They cut costs. The stock did very well. But I was given the opportunity through talking about sort of randomness through a friend who worked in HR at Honeywell. And she said, you should think about working here. And that's big global industrial company. And as I said, big global industrial company compared to fun, cool music studio in New York City, seeing Adele play in front of you, when she first releases her first album. That big industrial company didn't sound that appealing at first until she told me about the corporate pension and that they were hiring for a portfolio manager for private equity. And this was in 2008. And I thought, well, that just sounds like an interesting job. And a good fit with my background, and it was wonderful. And I met you, Chris, as you know, on my very first day at Honeywell.
It's so funny because first day and my youngest was within a day or two of her own birthday. So a lot of things conspiring in that first week of August, 2008, right?
Exactly. And I was there for 11 years, and it was a wonderful experience. And, I learned so much about so many different industries. It's one thing that's really fun for a limited partner is that I see real estate, I see healthcare, I see financial services, I see consumer, I see growth equity, I see a little bit of venture, I see direct lending, I see big LBOs, I see big software companies, small software companies. It's a very diverse job, and it's also a very people-oriented job. And I think part of picking managers is not just the performance, but do you think these are good people and they work well together?
Well, by the way, I think you literally must be reading my questions I had for you because you just gave a great segue. My next question up was, let's talk about people. Seriously. So, you've been investing in an industry that is blind pools. You're picking managers, they have a track record, but you're giving us money for investments that haven't been made yet. So this idea of a blind pool of capital, which means really the people are just almost it. Of course, again, strategy stated and track record and all that sort of thing. But you now have 16 plus years to rely on of your own development of a gut on people and instincts, et cetera. And it's not always in the numbers, right? So talk a little bit about how that gut you've developed, the things you maybe over this couple decades of doing this, how that people equation's kind of changed or stayed the same for you.
Sure. I mean, I think there's two layers, right? There's the people the management teams of the companies that these private equity firms buy, right? And then there's the team that's making the investments. So it's a judgment call on all of the above. And I know, like you do, that every successful company, it's really about the people and the management team. And every unsuccessful company, it's about the people and the management team. And that just gets proven over and over again, regardless of the size of the business, regardless of the size of the private equity fund. It's always about the management team. It's everything from the CEO down to people that they hire. And every private equity firm has a very different culture. I mean, we see all different kinds. We're invested with some of the largest, publicly traded asset managers, where the visionaries and the beginning of private equity was, sort of that group. And they have their cultures, and then it gets all the way down to, a small venture fund with their culture. And getting to know the people, I think, is really important. A huge part of my job. We also like to source co-investments, which is another, I don't know if you want to talk about that, but where the investors can also directly invest in the companies that the funds invest in. And in order to make that relationship successful going forward, you really have to get to know the team. You have to really understand, who's actually doing the deals too at the companies. I mean, that's something that's understated because, investors look at a private equity firm and say, they've got a great track record, but it may be one or two individuals at that firm who are kind of doing all the work, or the best ones, or the best. So you have to understand not just sort of the people and how they all work together, but who's actually, who are the most talented people in the firm and be able to identify them. And then transition is a really key aspect to any private equity firm because these are long investments. They're typically 10 plus years from when you commit to when you finally get out. And during that time, lots of things can change and people retire, people leave, people get another job, people pass away, unfortunately. It's really understanding the people and how they work together and do they work well together. And as an investor, it's impossible to know what's going on sort of behind the door because you always get the rosy, it's like a marriage, right?
The sales pitch is great. So there must be some things you've looked for, they're pretty consistent. I know you don't want to give your secret sauce away, but the things you're trying to look someone in the eye and ask or get a read for, obviously honesty, transparency. I mean, but are there some things that maybe would be red flags that you would be willing to share that you kind of go, this is what makes me nervous when I'm meeting someone?
Well, honesty and transparency is very true. Like any job, you learn, I mean, it's a pattern recognition, right? There's a pattern recognition that you only achieve having done something for a long time, right? That you can sort of smell when things don't feel right. At the beginning of a commitment, we have to negotiate documents with the funds. And, I had one situation, the manager, where, we made comments and they sort of said, no, we're not taking any of your comments. And he was the head of a private equity firm. He hadn't even read, he didn't even know what my comments were. That to me was, a red flag.
Like you said, it's a 10-year plus partnership. It's going to be on,
Yes, exactly. And, how does the team get on with each other? And that's a dynamic that's really important too, right? Is, how do they, because there's obviously economics play a big part in this industry, and making, having people at firms with different economics within the firm, different ownership levels, different amounts of carry that they receive. You sort of have to understand how all that works to make sure that people who work there are happy and are likely to stay.
Right. So somewhat shifting gears, but not totally. Many years ago, this is sort of the inside Edison baseball a little bit, but inside knowing your background with me/Edison, we had a conversation about, hey, adding value. Edison could benefit from more operators, more people can help the portfolio companies. And, I give you, maybe I don't give you enough credit, but I think some CEOs had suggested it. As you know, having hired Kelly, you mentioned earlier, in our shop was sort of the beginning, but today we call it the Edison Edge. These value creation platforms, we've named it, we've expanded it. Many thanks to you for the push on it. What I'm curious about is mid-market growth, buyout, and large cap buyout. Everyone's got one now. Like, I'm saying that you as an LP and all the things we just talked about, people, the underlying portfolio, track record, all that stuff, they're also coming at you with, we can add value. How do you distinguish between, I'll call it slideware, PowerPoint-ware, and talking about adding value and true value creation? And I ask that both sort of selfishly to know kind of what I should be doing better, but kind of from a management team's perspective, what should they expect from their investor? Because it's the same thing, like what you're expecting in terms of adding value, the management team's expecting as well. So I'm kind of curious, how do you evaluate? Everyone's got one value creation platforms these days.
No, I think that's true. There's so many and they're all different. And like you said, if you read a pitch book that comes from a private equity firm, everybody uses the same terminology, the same jargon. But, there are different models, and I think different operating teams or operating expertise is applicable to different strategies amongst the managers. So, if you're a manager that buys, I'm just thinking like a larger buyout firm, right? You buy the best, I won't name names, but you buy the best companies, right? You probably pay more, you probably pay a higher multiple, right? What do you need to be successful in that situation? Do you need a bunch of former CEOs to come in and tell that CEO who's been managing that business for years and knows how to do it, what to do? No, it's not necessary. So for different business models or different strategies require different operating partners. And there are very, very, very intensive operating models where specifically the companies that are being bought, need a lot of work, and they have lots of issues or challenges or, operational complexities, and you need like a lot of hands-on people. That's one model. Then you have the model of, we're going to do exactly the same thing to every single company, right? And there's a few of those, in technology specifically, right? Where there's a specific model of, we want this type of business. We want business with this margin and this revenue growth. And we're going to create that by our operating playbook or platform or whatever you want to call it. So again, we first of all, as an investor, we have to say, well, what types of businesses is this private equity firm investing in? And what kind of resources would be helpful for that model? No platform fits every strategy. In the Edison case, for example, and what I think you've done a great job with at Edison is to add the capabilities that some of the companies that you invest in, it may not have or may not have had the experience, and allowing them to scale, right? So, I should have said this, like the size of the company and the point in their sort of evolution requires very different, right? A business with 20 million of revenue and growing quickly and doesn't have any cash flow is very different from a business with 40 million of EBITDA or whatever. So, and requires different skill set. And some managers, it's extraordinary because we see so many different companies. I mean, there are companies out there that are now, huge multi-billion-dollar companies where the original founder is still the CEO. It's unusual, but it definitely, exists. But for many, either they don't know how to do it or they don't even want to do it because they want to be entrepreneurial and they don't want to be, at the point where they have thousands of employees.
Is it now bureaucratic versus the creative stuff?
Exactly. So I think, understanding the point at which your companies, where they are in sort of their evolution and in their scale, that's how you sort of determine what the value creation, can be. And I think it's really interesting to see firms that were sort of early in building this out. I mean, I think for your size firm and for growth, you're on the earlier side of this. We have some managers that, the fund now is, most of the companies, have, I don't know, 40 million of EBITDA, and they've had operating partners for some time. And those operating partners were CEOs or CFOs of big public complicated businesses, 100% working for this private equity firm, and they're totally engaged and they're still young. And there's that model. And then there's also sometimes you'll see the pitch book where you'll have the in-house operating partners, and then you'll have the operating partners that are sort of retired, and they might be spending more time on the golf course than they are spending, adding value to the firm. You can tell based on how the firms speak about their operating partners, how visible they are to the LPs. One thing I find, being a good indicator of probably good resources is the operating partners who used to be the CFO or the CEO of one of your prior companies.
This does a lot about, do they like working with us or with that firm?
Exactly. They've worked with this firm before. They know what they're getting themselves into. They know what it entails to come into their company and contribution and make changes. So
going back to, you mentioned co-invest or direct investing. So co-invest with someone like me in a portfolio company. We have our own thoughts on this, but CEOs and management teams, because earlier you said GP, are the things you're looking for from a CEO that may be different than the GP that we talked about earlier, the manager of money, if you will, versus an operator? And as you think about your own CEO profile, are there telltale signs of people you feel like work versus don't work? CEOs in a direct investment. That's sort of what we get paid to do full time, right? That's our job. But when you're doing a co-invest, you got to have your own point of view on the management team.
Yeah, well, I mean, I think in a lot of cases now, private equity has got a lot more sophisticated in their review of CEOs in, because in these diligence processes, it's not always easy for a PE firm to really evaluate. There's now a lot of tools that a lot of PE firms are using, like psychological and, these evaluations and very broad interviews with reference checks, like going back throughout someone's career, talking to everybody they've ever worked with. I think that is much more common now. I think oftentimes, in PE today, there's a lot of situations where a private equity fund might be raising money for a company that they already own. They may have owned it in a prior fund, or they may be doing a continuation fund. So they're trying to keep it and hold it longer. In that case, you already have a CEO and a management team that is known. And that becomes more and more attractive to co-investors looking at a management team. If we can't meet them and spend a lot of time with them, which today is much more the case. I mean, I remember in the days at Edison when I would be on a board of one of your companies as an LP. And I mean, at the large firms, they're very broadly syndicated co-investments. Even at smaller funds, become much less the sort of personal get to know the team. It's a lot of times the diligence for co-investors doesn't even involve meeting the management team. I mean, it's very different.
Yeah, you get maybe a quick call, or if that, you're trusting the GP. It's back to trusting us, right?
Yeah, it's back to trusting the GP, but I think also that having a management team that's been working at a company for some period of time and has had proven success at that business can be definitely a risk mitigant.
Now, earlier, staying on this people theme, you mentioned about advice you give to young people, like keep your options open. You never know where the next opportunity is going to be. Talk a little bit about mentorship or role models, and kind of that same view of what you tell your kids or someone else's kids that are going that first, second, third job.
A mentor is somebody that you've worked with or worked for, who you admire in the workplace, that they're effective, and you try to pick up on some of their attributes. I mean, I'm just very fortunate. I've had incredible managers everywhere that I've worked, and I've made a point to stay in touch with them. And many of them are very close friends of mine now, the people that I've worked with. An extraordinary group of people at Lehman Brothers that I worked with who've all gone on to do very different things. And, at Sirius, there's still a lot of the people that I work with are actually still there. But to stay in touch with people and take advantage of that is so important, especially when it's somebody that really identifies as somebody who's talented or just has a good way of managing other people. In my very first job after college, I worked with a guy, I'm sure he won't mind me mentioning this. His name's Mike O'Grady. He was a first-year analyst coming out of business school, and I was a first-year associate coming out of business school, and I was an analyst. And I worked with Mike, and Mike is now the CEO of the Northern Trust Company. So all that time, like we just worked together on a lot of deals, and just a great guy. And I stayed in touch with him over the years and sort of watched his career blossom to now where he, has an incredible CEO of a public company doing great things. So it's really staying in touch, identifying characteristics and being fortunate to work with good people.
So the young people, if you see someone working hard, also having good results, follow them, build that relationship. And I do like your point because it's funny, early in my career in the accounting world, we had this mentorship program. And fortunately, I had a good one, but the more organic relationships that grow over time, or I'm with you, it's hard to have a formal program without it feeling a little contrived.
Yeah. And then another piece of advice I give to students, especially business school students, is if you're going to go and spend all that money at business school, take the classes that you may not think are the most important classes for business, such as, organizational behavior, marketing, the soft stuff, which is so incredibly important. Because I remember I focused on finance and accounting because that's what I'd done in banking, and I wanted to get good grades and I wanted to get a good job. And I thought that organizational behavior and operations, which is plant operations and supply chain and all that stuff, which the world has changed a lot since I was in business school. I mean, we didn't even have social media. Social media didn't exist. SEO, none of it existed. But the very important sort of fundamental parts of a business are its culture and how it's operated and how it sells. And all those things were not at the top of my list of what's important. But I think having worked at SiriusXM and having experiences, as an investor and on some of the boards and as a co-investor, just to see how important those things really are.
Well, I had one more quick one on the business of our business, if you will, general partners, limited partners, investing. The PE industry in general, is in need of, shall we say, more exits, more distributions. It's been kind of quieter for the most part. Putting on your own prediction at, and by the way, for the audience's sake, we're not talking politics, but we are recording this on election day. So we'll Michelle make a prediction here on the show. But I would say the question, if you will, is will 25 be, do you feel like we're building momentum into exits? And how do you, not only at Loews, but as an investor, feel about where we are on distributions and exits? Is it acute as maybe some say it is, or it's not as bad as it is? What's your sort of temperature, and where's 25 going?
Well, I have heard that some deals are awaiting the results of the election. So although, and I don't know if that's true, we hear a lot, we talk to investment bankers. I mean, I remember being at a recent Edison function and you had an investment banker there, and he was talking about how the number of bake-offs or try to hire M&A, sell your company, was at an all-time high. So that's one side of it. We talked to the direct lenders who are looking to finance the businesses that are coming up for sale. And then we talked to a lot of private equity funds. And in those discussions, there is an expectation that next year will be better, but I don't believe there is the expectation that it's going to be a flood. They're not seeing it yet. The pipelines are still slow. And this year was, by all accounts, I mean, we surveyed all our GPs at the end of last year, and we asked them, how much will you be selling? How many of your businesses do you think you'll be selling this year? And how many new companies do you think you'll buy? And we asked all of them, and we put all the numbers into a spreadsheet, and we were nowhere close to that. And that was not my forecast. We asked everybody, we put it together, but not surprisingly, that's what happened, because the market or the PE community thought that rate cuts were coming sooner than they did. And they thought that the market would go back, not to where it was in 2021, but that it would come back. And there's only been one so far. Maybe there'll be another one, this week, but it didn't happen. There's many stories of how many companies were put up for sale that didn't ultimately sell. And that's what we don't see, but I've heard more and more stories about this. Like 75%, a banker who said 75% of the deals where we were the sell side never transacted, because the math just didn't work, because you had leverage at a certain level and a certain cost, and you had a multiple at a certain, it didn't make sense. It's just simple math.
So what I think I heard you say was, based on all the inputs you have, better, but not a gangbuster year. I would say that would be our general view. That 75% sounds overstated on my Edison's direct experience. However, we just didn't put companies into processes because of either feedback or knowing where the market was, et cetera. So there's some truth to the 75% if you think you push deals out, they were kind of taking your chances. So to kind of bring this to a close, I sort of have a lot of people questions. I think in your business, in our business, and you started with this way, culture, peoples, make all the difference. I like to call this when I was 25. So this isn't the, what do I regret question. I don't think no one should have regrets. Like you learn from mistakes or whatever, but I call it when I was 25 because my second startup was a magazine business. We had this cool column. We had people write, certain people I remember as sort of kind of celebrities in their own rights, but someone like a Tim Russert who Meet the Press a long time. And like people like that stand out for me were like, they wrote this article and there was these interesting tidbits you learned. So I turn the question around to my guest and I say, so it's more like if I knew then what I know now. So when I was 25, you talked about your business school classes, things you take now. That was interesting, I think. But what else sticks out for you I know a lot more now than I knew then.
Well, I think having, like we talked about this a little bit, having some actual business experience of working in a company for kids who are coming out of college or they're doing the consulting, banking, accounting path, they're all service industry, right? And you can do that, but you can't really learn or appreciate some of those sort of dynamics.
Yes. To put about sales, marketing, finance, all coming together. Yeah.
Yeah. So I think having that ability or that experience of actually working in a company, or there's lots of kids now who are coming out into sales roles, especially in like some of the big software companies. They have big programs. They hire lots of kids right out of college. But I think that experience, whether you're selling, medical products or you're selling software, I think that experience is really invaluable to being well-rounded, right? To being well-rounded.
I can't agree more. My father was a salesman and they owned his own business. And he used to say, nothing happens without the first sale. So you got to learn that skill somehow, even if it's observing somebody else's. And frankly, in our business, right, we have to sell you. We had to, of course, deliver the goods, but how do you articulate the pitch? How do you create the value proposition? It's great advice, really good advice. So Michelle McKinnon, thank you so much for the time you're joining us on Electrifying Growth. I think it was really neat to hear the other side of the table, as I called this, perspective of someone who's been in an operating role, but had been a long time limited partner. I agree with one of the things you said here today. Our job, yours and mine, we're really lucky because the amount of differentiation and different people we meet and super smart, super motivated. We're really fortunate. And I know I've been fortunate personally and as Edison to have your partnership for the last 15 years. So thank you for that. And always your advice is we listen to it and it's always thoughtful, which is, I can't say that about all folks in your business because you're really thinking about how does that, relationship improve. So thank you for joining me, Edison, and helping make an episode really interesting. Thanks for this time with you.
Yeah, no, it's a pleasure. Thanks, Chris.
Thank you for joining this episode of Electrifying Growth. A special thanks to this week's guest for sharing their time and insight. For more resources, inspiration, and a look inside the Edison Partners Network, sign up for our newsletter at www.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.